Imagine this. Your freight rate is stuck, maybe even dropping, but the fuel surcharge on your invoice just keeps climbing. It sounds contradictory, a financial squeeze that makes no sense. But this isn't a hypothetical. It's the harsh reality unfolding in the freight market right now, July 2026, and it's hitting your bottom line harder than you think. Let's break down the numbers that define this paradox. This week, we've seen van rates slide by 1%. Reefer rates, often a bellwether for perishable goods, are down a significant 6%. Even flatbed, which has shown some resilience, is only up a modest 2%. In a normal market, these rate declines would suggest an easing of overall transportation costs. But here's the kicker. Diesel prices jumped by 5% this week alone. This isn't just a slight uptick. It's a substantial increase in a carrier's most significant variable cost, directly conflicting with the downward pressure on base rates. So, why aren't fuel surcharges covering this gap? To answer that, we first need to understand how fuel surcharges are supposed to work. Traditionally, a fuel surcharge, or FSC, is designed to protect carriers from the volatility of fuel prices. It's typically calculated as a per mile or percentage of base rate charge tied to a national or regional average diesel price index, like the DOE, Department of Energy. Weekly average. The idea is simple. As fuel prices rise above a certain baseline, the surcharge kicks in, compensating the carrier. When fuel prices fall, the surcharge decreases, ideally benefiting the shipper. The problem, however, is that the traditional FSC mechanism is fundamentally failing in this unique market. There are several critical reasons. First, there's the lag. The DOE index, while widely used, is usually a weekly average. This means carriers are absorbing immediate, daily fuel price spikes for days before the FSC even adjusts. By the time the surcharge catches up, fuel prices might have already moved again, creating a perpetual game of catch-up where carriers are always behind. Second, and perhaps more importantly, is the basis. Many FSC agreements are built on a very low baseline fuel price, perhaps from years ago when diesel was significantly cheaper. While the surcharge percentage might seem fair, the baseline itself is outdated. This means that even with a rising surcharge, it's not truly compensating for the actual, much higher cost of fuel today. Carriers are paying a premium at the pump that the FS simply doesn't reflect. Third, and this is where market dynamics become crucial, is the issue of market power. In a buyer's market, where freight volumes are softer and capacity is more readily available, shippers have leverage. They can negotiate lower base rates. Carriers, desperate to keep their trucks moving, often acquiesce to these lower base rates, hoping that the FSC will make up the difference. But as we've seen, the FSC isn't designed to make up a difference that significant, especially when the base rate is already compressed. This creates a cost-plus versus market rate battle. Carriers operate on a cost-pluses model. They need to cover their operating expenses, driver wages, maintenance, insurance, and, crucially, fuel, plus a reasonable profit margin. Shippers, on the other hand, are driven by market rates, what their competitors are paying, and what the supply and demand for capacity dictate. When market rates for freight plummet, but the cost plus for fuel skyrockets, carriers are caught in an impossible squeeze. Their margins evaporate, leading to a precarious financial situation for even the most efficient fleets. The impact on carriers is immediate and severe. Squeezed margins mean less capital for equipment upgrades, less for driver pay increases, and ultimately, less ability to maintain service levels. We're already seeing instances of carriers selectively choosing loads, turning down freight that doesn't adequately cover their fuel expenses, or even exiting the market. This isn't just a carrier problem, it's a supply chain problem. For shippers, the impact is insidious. While you might be celebrating a lower base rate, the rising fuel surcharge is eroding those savings, often making the true cost of transportation significantly higher and less predictable. This leads to budget overruns, inaccurate forecasting, and ultimately, instability in your supply chain. You might think you're getting a good deal, but the hidden cost of fuel is quietly sabotaging your financial planning. So, what should shippers do about it right now? The good news is, you're not powerless. The first immediate action step is to reevaluate your current fuel surcharge mechanism. Don't just accept the standard DOE, index and baseline. Scrutinize the formula. When was the baseline established? Is it truly reflective of current fuel costs? Consider negotiating a more dynamic FSC that adjusts more frequently or uses a more current baseline. Some shippers are even moving towards a cost-based FSC, where actual fuel receipts are factored in, though this requires greater transparency and trust. Secondly, leverage data and market intelligence. Tools that provide real-time fuel price data, combined with granular insights into lane-specific rates, are invaluable. Understand not just the national average, but regional and even local fuel prices that your carriers are facing. This data empowers you to have more informed conversations and negotiate from a position of strength, understanding the true cost pressures on your partners. Third, engage in strategic carrier partnerships and contract renegotiation. This isn't about beating down your carriers. It's about finding mutually beneficial solutions. Openly discuss the fuel surcharge paradox. Explore longer-term contracts that might offer more stable pricing, or consider incorporating fuel hedging strategies into your agreements. Some shippers are offering guaranteed volumes in exchange for more favorable FSC terms, creating a win-win scenario. Fourth, explore alternative transportation solutions. Is there an opportunity to shift some freight to rail, which is generally less fuel-intensive? Can you optimize your routes to reduce mileage? Are there opportunities for intermodal transport? Even small changes in your shipping strategy can yield significant fuel savings, especially when diesel prices are this volatile. Looking beyond the immediate crisis, the long-term view involves a greater emphasis on efficiency and technology. Investing in more fuel-efficient fleets, exploring alternative fuels where feasible, and utilizing advanced route optimization software can all contribute to mitigating fuel costs. Some progressive shippers are even exploring fuel price hedging directly, though this is a more complex financial strategy. In conclusion, the July 2026 freight market paradox, where base rates fall while fuel surcharges climb, is a critical challenge. It's a clear signal that traditional mechanisms are failing to keep pace with market volatility. But for shippers, this isn't just a problem to observe, it's an urgent call to action. By dissecting your FSC mechanisms, leveraging data, fostering strategic partnerships, and exploring alternative solutions, you can reclaim control of your transportation costs and navigate this turbulent market more effectively. Don't let the paradox silently erode your profits. Take action now.